We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Patrick Karim, co-founder of NorthstarBadCharts.com. Pat, how are you today?
It's always an honor to be on your show. I'm doing great. Best summer ever here in Quebec. Super warm. And I hear you got all the rain for us there.
Yeah, we've had a ridiculously wet summer, so I guess we get the opposites here this year.
Yeah. No, I can't go wrong with the sun, man. It's in my blood, maybe because my father's Lebanese there, but I rather sun way more than I rather wet snow or cloudy skies there.
Well, it's good thing that you're getting out and enjoying it instead of being stuck inside and stuck behind your monitor and your computer.
Yeah. Well, 100% after this interview, man, I'm going to go head outside, jump in the pool and just enjoy it there while it's there, you know.
Perfect. So Pat, I thought we could start today by talking about this broader theme of a capital rotation event, what that means to you and what indications are of something like that happening.
Yes. All right, guys. So you might have heard me and or Kevin Wildforce talk about this capital rotation. Well, I'm going to share, guys, I'm going to share you my screen because as I talk, you'll be able to see the proof, guys. All right. So whenever, guys, you look at a chart, step one is always see what you're looking at. And right here on the top is the SPX since the early 1900s. All right. So I have the SPX on the monthly chart on the log scale. And you should always put instruments on the log scale, guys, unless there's a negative value. I see some people, sometimes they put linear scale, but if I would have put the SPX on the linear scale, it would just look like a hockey stick. And after that, you can manipulate your audience. Look, it's gone too high. It has to crash. Well, there's a whole bunch of these regions here where it would have looked like a hockey stick, but because you're looking on the wrong scale, you have to put everything on the log scale. And here at the bottom, I have what's important for the CRE. Here at the bottom is gold versus SPX. And I'll bring your attention to when gold moves up versus the SPX and SPX goes down. Of course, here gold was pegged, but you still had a capital rotation here in favor of gold because silver at that time also went up, oil went up, and they weren't pegged. You can have a capital rotation event. So step one, gold moves up versus the SPX or the stock market. Because I'm pretty sure the SPX didn't exist back then, but it's backfilled created. And then you have the stock market that has to go down because this is the instigating element is once the markets start going down and there's a recession, I have to show you this chart after, Tom, there. The government takes on more debt. So it prints the money, it borrows the money, stimulus programs, bailouts, all that stuff. And gold loves that. They're gold, silver, commodities. On the recovery side of that, they love that. They smell the destruction of purchasing power required to save the U.S. equities. So while the U.S. equities, they're trying to keep it afloat, that's when the capital rotates. People, as the money is leaving the stock market, it's going to gold, silver, uranium, oil, all that stuff. And even on the recovery side, as the SPX goes back up, there's more money that still goes into the commodities. So here we had one. Here's the other capital rotation event in the late 1960s in favor of gold. So here's gold actually breaking out in the 70s, early 70s versus SPX. But not just that. Look what happens to the SPX. It goes sideways there. It breaks down here. It has a bear market. I think it was 30, 40%. Then it rallied up, marginal new high. Then it goes back down 40, 50%. And it went sideways for 10 years. It went sideways. So while the stock market went sideways, the capital has been rotating into gold, silver, uranium. I'm repeating these, but like the gains of silver and oil there during the 70s was just absurd. So instead of holding on, once you realize it's a capital rotation event that's been confirmed, you got to get out of here. And again, there were a whole bunch of recessions here. That's another thing. Once you have a capital rotation event that's been instigated by the first recession, the probabilities of having subsequent important recessions, they augment. So here you had a whole bunch here in the 70s, and here you had some. And look at here, 2000. Once again, capital rotation event. Gold starts outperforming SPX. SPX starts faltering, the dot-com bubble. That was the first important recession. Then you get a rally back up. Another recession, GFC here, we go down again. And look what's happening. The price for the SPX going sideways. But gold, it doesn't go sideways. It goes up and up and up. And silver went up even higher, outperformed even better. Gold and SPX outperformed practically everything. Silver at that moment. And guess where we are today, Tom? We are back where there's potentially here a rounding bottom. There's a clean breakout line now that's morphed into existence. One reaction, two reactions, three reactions, four reactions. So I highly suspect that the next time gold breaks out versus SPX through this line here, it will be accompanied by an actual SPX breakdown, because you need that. As long as the SPX keeps going up, it's hard to have, you cannot have a capital rotation event confirmed, right? Gold might go up in the bull market alongside SPX, but you're not really rotating capital. It's just two asset classes going up together. A capital rotation is when one actually goes down, the other one rockets upwards, and the other one goes up again, but the other one, it keeps going up. It has a higher jolt, more energy. So once we get that,
Pat, is it that the capital is rotating out of, let's say, the SPX into gold because of that outperformance?
That probably helps. So at the instigating, I don't know what the fund managers, their reasoning is, but once you get that recession, money is evaporating from the stock market, and then maybe they're rebalancing into gold or safer assets, whatever. But then on the recovery, they see gold outperforming the SPX, they see silver's outperforming gold, and they probably see those returns in the first few years, and then they start allocating, and that could help sustain for the next 5, 6, 8 years. Because when that happens, you have a capital rotation event. It's for the next 8, 10, 12 years that the money flows, so that money flows just keeps piling into those commodities, and they keep going up and up. And that is important. And there's one thing you could see here on this line, guys. I highlighted 1949. This is a long term. This is a 300-month moving average. Very long term, guys. 1949, 1974, 2009. I put that out there, guys, because people sometimes they see the stock market and they want it to totally implode, go back to zero. Look, the odds of that happening there, it's practically zero. But what does happen is a reversion to mean. So I'm highly suspecting that once we get the capital rotation event, if the markets have a hard time and they just start going sideways, right? They go down 30, 40%, they'd have a nice run up going up 100. Now they go down another 50%. I think we're going to get a retag of that very, very long-term moving rising average. And once you touch that, that's probably we're gonna have to look really close at the charts, because there's a high likelihood also that we're probably in the final blow off top for gold, for silver, all that. Because once the markets bounce off this long-term moving average, and then they start and after that, once they break out, that's usually the top. That's the bull era top for the precious metals, commodities. They have a hard time after that, because now the capital is rotating back into the stocks, right? It's a growth environment. People are saying, well, look, the stocks are giving me better returns than gold, silver. Why am I holding that thing, right? Mm-hmm. So then after that, the money starts flowing. And look at this. We've been running hot for a while now. So look at the stock market here. It's been running hot. It ran all the way up through the 50s, the 60s. Here we have the nifty 50s. They couldn't do no wrong. Then sideways. Then after that, it ran hot for all the 80s, 90s, all the way to 2000. And now it's been running hot since 2009, 10, 11. What are we, 2025? So we've been running hot for 15, 16 years now. Anybody that's telling me that we are in a low risk entry point for stocks, they're the bonkers. The low risk entries, they're down here on the bounce of the long-term moving average, starting to move up. We're nowhere close to, I have to show you this other chart. So it might remind me, total public, I'll show you the public debt chart, but I want to show you guys this chart just to show people how the stock market is not in a low risk entry. This is the stock market compared to currency in circulation. Often people use M2, but the M2 money supply, I don't have data going all the way back to the 1900s, early 1900s. So I use currency in circulation, but it's the same. Same stuff. I'm sure you had other guests that the compared stock market, whatever, to price to earnings, all whatever fundamental metrics, you're stretched. Here's the Great Depression, the .com, not the .com, but the 1920s top versus currency in circulation. Then it's the unwind. Here's an echo bubble top, unwind. Here's a Nifty 50s topping pattern here, then unwind. Here the .com bubble above, top, unwind. Look where we are today. We're at the same levels we were back in, I think it's even higher now because this chart is back from December of last year. I think it went down and it's even higher now. So this is what the takeaway from this chart, guys. Look at this objectively and see the number of samples or data points that are below this line here. So majority of the time, SPX stays within this range below that line here. And once you start peaking above that dashed line, you're in bubble territory. It doesn't mean it's imminent implosion, but it is telling me that once you go above and once you start going back down, that's where, okay, this is unwinding. So you let it inflate. Remember, it's crazy. Like in the top bubble there, stuff could go up 50%, 100%. Like the euphoria, you can't try to short that. It makes no sense. But once it starts unwinding there and really starts losing some rising support lines, a rising support line here, horizontal lines here, that's when you know, okay, that's it. And that's probably going to happen at the same time as the first chart I showed you, the gold versus SPX going to probably be breaking out. And this is always accompanied with the actual stock market also plummeting and entering bear markets as this unwinds. So that's another big piece of evidence. Stock markets, I'm sorry, but they are not in low risk entry point. And that sets the stage because anything could happen now when you're in that stretch, Tom. This is where I know bears, perma bears, they can't talk anymore at this stage because if somebody was perma bear since 2009, 8, 2011, by the time this happens, he has no credibility yet, right? Left. But he's going to be right eventually. But me as a chart trader, I can avoid saying I'm bear. Like I know I'm going to wait for the evidence to happen before calling something more meaningful. And if you let me rant just a little bit more, this is the total public debt chart, the quarterly chart. So it's the U.S. federal debt. It's the money they spend, for a whole bunch of stuff that they need to run the economy, for programs, the stimulus, all that stuff goes in here. So while I know now we're above 35 trillion there, I don't know what the latest 36, 37 trillion. So people should not be impressed by that number because they're just destroying purchasing power. Whenever you start seeing data series from bottom left to top right, guys, in your mindset, don't be impressed by that. It's like, this is just a regular upward sloping logarithmic advance of destruction of purchasing power. So that's not what you should look at. What you should look at is the actual distance from the moving average, the explosions in that debt that really triggers, that should be warning signs for you guys, for, clues at what's happening. And look at this, Tom. Here is the distance from the 6-quarter moving average. Mm-hmm. Look at the and here I have the recessions overlaid, the green overlay. Look in the late 60s as the total public debt, it's always going up, but it's exploding faster. It's accelerating, breaking out. Guess what they were reacting to? Recession. Mm-hmm. Same thing here. The total public debt explodes, recession. Total public debt explodes, recession. Same thing here, recession. The 2001 total public debt, new uptrend, recession. Recession in 2008, recession, the micro recession for the COVID stuff. So right now I would have to update this chart, but the idea is that as long as you're low, you're still in an environment where recessions can happen. And as soon as that stuff starts turning up, then it's a reaction to something bad. Every single time, guys, this thing rockets upwards, they're reacting to something bad. So that 35 trillion, 37 trillion, I think it's peanuts. It doesn't matter, that number. As soon as the rate of change or that distance from the moving average explodes upwards, we could be at 40, 50, 60, 100 trillion. It's that number is, it's an illusion, guys. This is priced in fiat there. It means nothing, right? The rates of change are important. And again, I'll show you some more details because I've stared at these charts forever.
Mm-hmm.
Look at here, higher lows on the distance from moving average, higher lows, higher lows, higher lows, higher highs, higher highs. Guess what was going up here during this period there in the 70s? Gold, silver, uranium, oil, all that stuff was going up in that period. So when you have, even if you have cycles of accelerating and decelerating, but ever increasing total public debt, you're in an environment where gold, silver, they just, come on, give it to me. You're printing money, destroying my purchasing power. The market's gonna reprice or price accordingly all these commodities. And look here, the 1980s, 81, 82, as the rate of change, the distance from moving average was deflating. Look, the money's up, the total public debt keeps going up, but it's not going up as fast. This was the greatest bull era ever for the stock market, right? Stock market keeps going up and up and up and up until we happen here. And again here, 2000, 2006, 7, look, higher lows, higher highs. Get what was going crazy in that period, Tom? I don't have to answer that. Guys, you know, right? I'm good. You know, the commodities were severely outperforming. So this is a setup. If we'd be high and starting to unwind, I'd say, guys, we can't go long commodities. It's this environment setting up for growth stocks. But guys, we're low here. So as soon as that stuff starts moving out there and breaking above here, you got to look at commodities even more. So even if they've been going up in price, like, guys, I know you're going to tell me, Patrick, everything's going up. Yeah, doesn't matter. For me, what's happening now, it's small potatoes compared that to what's going to happen next. The crazy moves for gold, they don't happen. I know gold's went up from wherever it was, 2,300 to 3,500. That's nothing compared to what's going to happen the next time they open the spigots and they start printing. That's nothing, guys. That's how you reach gold price could keep going logarithmically and going to 8,000, 10,000. Silver goes 80, 90, 100. That's how it happens. It happens above here. It doesn't happen below here. Right now, it's bull markets for everything. Stock market's in a bull market, gold's in a bull market, silver's in a bull market. All that stuff's in bull markets. But the next crazy recession there, we gotta, whenever that happens, the next unemployment numbers, we have to revise the numbers. Like these crazy moments, and the market realizes, hold on here, we got a problem. And they start opening the printing stuff there. That's when everything goes bonkers. And yes, US stocks will go down at the beginning and they will recover and they'll have impressive recovery rallies. But the recovery rallies will be outshined by gold, silver, with them outperforming the stock market on the way up.
So Pat, you had mentioned earlier this difference between log charts and linear charts. Why is that, that different way of looking at it very helpful?
Look, guys, because I don't want to call them snake oil salesmen. So I used to do linear charts without realizing the importance of it in my early beginnings. But the more I studied, the more I realized that, hold on, Pat, you gotta stop using linear charts, because I'll show you this chart. Look, here's the SPX chart. Since 1871 on log scale. Here in the bottom is 1871 on linear scale. Look when I put on the linear scale. You can't see any of the details here, but yet the price has moved in an important logarithmic way, like in percentage, it moved up a lot, but you can't even see it here on the linear scale. And if I would have zoomed in on that period here, right here, or here, look, I can't even see the 1929 market crash. We know it went up crazy. I can't even see it. If I wouldn't have this current, the linear scale will always amplify what's happening on current price action, because the price is moving in a logarithmic way. Then the linear cannot properly represent the price action that happened before. This in the 1929s, it probably looked like this on the linear scale. Imagine this, guys, is 1929, or the ramp up to it. It would have looked exactly like that. So number one, it hides the truth. It hides past performance. You can't see it. It's a flat line. And look here where there's importance. Here, look at the starting point. I have this long-term rising trend line here, support line, that's very valid for the SPX. It started in 1932, one touch, 2, 3, 4, 5, 6, 7, 8, 9, 10 touches, super valid rising trend line. Here, I drew that rising trend line. I can't even see what's happening here. And since 81, 82, 83, 84, the price on the linear scale starts detaching itself from it. So I can't even touch it. So it's totally useless on the linear scale, but it's very valid on the log scale. But I'll come in even closer here. Look, I have another starting point, 2009, February. Look at this angled rising trend line here. 1 touch, 2 touch, 3 touch, 4 touch, 5 touch. So here I have a very meaningful support line with multiple touches. Does it have to get retouched? No. But if price does go back there, I'm going to expect some type of bounce here or some reaction. And if it breaks below, I'll know it's important. I'll know, okay, maybe I'm going to go retest that longer term rising trend line. That same trend line here at the beginning, because price has not moved in logarithmic yet, 1 touch, 2 touch, 3 touch, 4 touch, 5 touch. But look, the price has started to move in logarithmic here. I'm super stretched from that rising trend line. And that level right here is about at the 3.5K on the linear scale to a retouch. So if somebody's drawing on the linear scale and says, oh, look, I have a rising support line here, that's my target, 3.5 on a retest. But hold on. On the log scale, that equivalent rising trend line with the same starting point is at 5.4. So the log is showing you important support that will hinder the price, will support the price before it even reaches your 3.5K. So you're looking at 5K and thinking that's my target. The odds of the 3.5K getting touched are severely diminished because you have important support here that you can't see on the linear scale, but it is 100% valid and it is there on the chart. Mm-hmm. And what is valid on both scales though is horizontal lines. Horizontal lines are fine. Horizontal line is fine here, these lines, any things that's horizontal, it's fine. You're okay with that. So always, guys, unless there's negative values, always put log. Because if I go on, I'll show you this example, guys. My goodness, I'm so happy you asked me this question there. Here is the Bitcoin chart. I put Bitcoin here. I have Bitcoin here, 8 hour. Okay, I'll put on 1 hour here. I'll put 1 hour here. And here I'll put here log scale. Okay. So on the right, I have Bitcoin on the linear scale, and on the right, I have Bitcoin on the log scale. On the shorter time frames, log will look exactly like linear. Like before the price starts accelerating in a crazy fashion there, I'm going to probably have very close support levels. Everything's going to look very fine here. So log is equivalent on the shorter time frames, on the smallest of time frames. Log will give you the same advantages as a linear chart. But log will adapt as I zoom out. I'm zooming out. And here I'm zooming out on the linear. Log linear. It will give me that advantage. I'll go here on the 8 hour chart. Here I'll go on the 8 hour chart. I'm zooming out. Here the log will give me, I'll be able to adapt to price that has moved logarithmically, while the linear chart will not be able to do that. I'll zoom out even more there just to show you the impacts of logarithmic moves. So here is the linear scale. Remove all indicators here, remove all indicators here. And here you can see remove drawings. Okay. So here I have pretty much the price of Bitcoin has moved logarithmically here over the years. And here you have, here's my starting point, 2017. 2017. Is it here? And you'll see that I get more realistic support lines than here. People thinking, well, look, here's my support line. It's going to go retouch that eventually. Look, it's not going back to before it gets to $42,000. It's going to stop somewhere here at $63,000. It just shows you important support that you can't see on the linear scale. There's practically no advantages of using the linear scale unless there's a negative value. Just put log, please, because people are manipulating you when they're putting that on purpose on the linear scale. And then I'll show you another trick people do. My goodness. What people do also, they put linear scale and they put the chart like this there. They squish it up there. And they tell you, oh, the price is unsustainable for Bitcoin there. And then they put a big arrow making it go down here. And they squish the scale here to make it look even more acute. Guys, don't those are parlor tricks there. I know them because I've experimenting with them. And over the years, I've noticed like, okay, I can skew the perception of a chart, right? So always make sure it's on log scale if you want truthful analysis, and make sure it's not all squished up like that. Make sure it's using at least the whole visual pane, and then you get some more realistic analysis.
So Pat, as we have that, let's say that foundation or that basis for kind of understanding these charts a little bit better, have we missed, let's say, the low risk entry points for gold at this point?
All right, that might get me in trouble, but yes, we have. But I will show you guys why you've missed them, these low points there.
And I think it's important to kind of like go back through and understand that this is more so for, let's say, trading rather than just actually, buying ounces and stacking.
Yes. Look, guys, of course, I understand. Look, in trading, you got scalpers in and out, like they hold less than an hour. Then you got day traders where they will hold the price for many hours a day. Then you got swing traders, days, weeks, they'll hold. Position traders, investors, they'll hold for. Stackers, they do not care about the price. Stacker, they care about ounces. I've done this story before, but I remember when I used to work in downtown Montreal. There's a colleague of mine used to go to Kitco. What are you going there? Oh, come, Pat, you'll see. And he used to just go buy ounces, go to a little booth, and he buy his ounces. He did not care about the price. Every single one of his paychecks, he would just get the money out and buy his ounces. And I'll show you why it's not wrong doing that there. Let me scroll down there, and I'll get back to you guys to show you why gold, we're past the lowest entry point. Here is the gold chart versus houses. Come on, guys. Okay, this one here. Here, check it out. So here's a single family home price since 1968, price in fiat, bottom left, top right. Why? Well, because it's not because the houses, they change that much. It's because they're destroying your purchasing power, right? A house is a house, guys. Can't, single family home. It's like people, oh, my house went up in price. It's worth more. Yeah, because your purchasing power went down, your house price went up. Yes, there are cycles within it. But look here, price in amount in ounces of gold. Yes, there's cycles here within it, but it's pretty much the same. It went way more sideways, and depending if there are cycles within that. So a stacker, he has that mindset. Says, I know that a range of 150 to 300 ounces of gold, 350 ounces of gold will that range historically will protect me. I'll be able to buy pretty much the same house with those amount of golds over the years, no matter what happens to fiat. So it's that mindset that a stacker has. Here is even here, oil price in fiat, bottom left, top right. But here's oil price in silver, practically the same amount of ounces of silver to buy that energy, right? That barrel of oil. So that, again, the stacker says, I'm going to be able to put gasoline in my car with my silver. I don't care. My ounces, no matter what the gas of price is at the tank, I will be able to purchase. I just need to use my ounces for that. And that's the proof, right? That's the range. There's cycles within that, but over long periods of time, that is what happens. And here's the gold chart. Let's go back to why we miss the low risk entry points. The low risk entry points, as I defined them. So once we got that out of the way, stackers stack, guys, whatever, a bull run. And stackers shouldn't even care there's a bull run or bear market, right? Be honest with yourself, guys. If you're a true stacker, you're going to buy even in the bear market. You do not care about the price, right? Stacker does not care. If you start caring about the price, you have to admit to yourself that, okay, maybe I'm a stacker, but maybe I'm still a trader kind of, right? So here's the quarterly chart for gold. 1 touch, 2 touch, 3 touch, 4 touch. Base. Nobody cared about gold here. Breakout confirmed. Bam. Low risk entry point. That's it. It's done. The moving averages were coiled and tight. I'll show you. I have another way of showing this to your viewers, Tom. The low risk entry point was here. What's a low risk entry point for me? It means the odds are of having a false breakout and price reverting and failing, which could happen, are diminished at this stage. That means the market, this important resistance, all the bag holders that kept selling here on the way up, have to break even, I have to sell. Once you're above that level, that resistance, that breakout line becomes support. And the bag holders, they're not there anymore. It's just the market telling you there's a new uptrend, right? Because here, higher lows. But now it's not just higher lows. I'm doing an actual higher high. And that is the definition of a uptrend. So that's the lowest entry point. It rides, it goes up. There, it went up. There's no entry. There's still no lowest entry point here. So people could exit. And me saying that there's no lowest entry point, I'm not telling you that's equivalent of an exit. Sometimes people are like very binary there. So lowest entry point just means I'm on the sideline. Can I enter here? No. But I've already been in. Should I exit? That's another question, right? That's not what I'm telling you guys here. So price went sideways here and up, 1 touch, 2 touch, 3 touch. So this pattern morphed into existence. And guess what? Once I get that valid pattern here and a breakout, that's my second low risk entry. It's right here, guys. That's it. There's every single quarter after that is you're distancing yourself away from that low risk entry. It's just gone. It's in the past. It's done. And look what happened after. It just rid up, beautiful uptrend. Sometimes it could have stopped here. It's riding, it's going upwards. That's how, so imagine that if I showed you these huge basing patterns, here's a multi-year one, here's another multi-year consolidation. For me, the next equivalent low risk entry, there will be low risk entries on the smaller timeframes, but the next equivalent, like low risk entry, will take a while, guys, because I'm going to expect a huge pattern here. I would love to see a huge pattern here for the next low risk entry here. I'll put up the gold chart. Could do this interactively. Remove all drawings. You'll see here. Look at the 2000 there. Let's say here you had here you have the original breakout low risk entry. There you have another even a rising trend line here. Here was the second. Maybe the second low risk entry up here. After that, it runs. After that, maybe here. Then you get the low risk entry here, or maybe here on this continue on the breakout above that. Then after that, the GFC, the next low risk entry after that is probably here. Breakout goes up. There's not that many, and eventually something's will look like a continuation breakout, and it will fail eventually. So here you get 1, you get 2, 3 low risk entries. And the fourth one, that was the end. So that's how many you usually get in those bull arrows. Here's the original one, 1. Here you got a second one, 2. Where's the third one? It's not even there yet. If you'll need some type of consolidation pattern like that. I would love that. And maybe that's going to happen when we have this CRE there, that capital rotation event there. Maybe the stock markets, they start going down. It'll drive gold down enough for it to do a beautiful retest of its rising support line. It's probably going to, it's that faster. And then after that, once that happens, then we break out. Because look, objectively, guys, look how stretched we are from that moving average. Back in April, I put a post out and people got super angry, Tom. Why do people get angry? Maybe it's me. Maybe they're not getting angry, but maybe they misunderstand what I'm trying to say. But I put this back in April right here, and I pinned it in my highlights right here. This is the distance from moving average. It's exactly this. It's the bottom pane right here in this chart. And we're in April. We're still going up, and it's hard to show a bearish scenario when stuff's going up. This is the hardest post I ever have to do is when I show a bearish possibility when everybody's happy, the money's coming in, right? My gold stack, I'm rich. It's people don't want to hear this stuff. So I said, look, guys, we're stretched. Every single time we've been that stretched from the moving average. We got the GFC here. The last time we were that stretched, it was the end of the bull market. Here in 2020, we weren't quite that stretched, but that was we started consolidating for a few years. So again, I told people we're approaching outlier territory, and statistically, you can't say I'm wrong there. It's most of the time we spend below that line here. So odds increase. So that was back in April 16th. And what the price has gone sideways since then, Tom. April is this candle here. We're still going sideways. 1 month, 2 months, 3 months, 4 months, 5 months. Like I don't know how long it was going to last, and I just knew the odds were increasing of it going sideways. And look, here we are. This is what people got to keep an eye out now. This is the dangerous line. Here's the distance from that red line. Here's my 36-month moving average. That's a distance from the price distance from that 36-month moving average. I'm going to zoom in on here. This is very important, guys. Sometimes I have to want to redraw with better accuracy. We're coming to retest that. Look, you don't want that line to fail, that support line on the momentum there. Here, look what happened when it failed back here in 2020. I'll put exactly here. It failed here. That's when the price still didn't close below its 12-month moving average. But look what happened after correction period. You don't know how long the correction period is going to last. People
churn sideways.
Yeah, sideways. So you have a choice. Either you hold on to it. And this was nasty, Tom, because look, a lot of people here, even me, I was starting to put more bearish scenarios out here. It's like, guys, look, we lost the moving averages. It's not looking good here. It's not. It was just on that time frame was not looking good at this stage. So there's opportunity cost. There's time moves on. This could have went down. I know people with hindsight, Patrick, it didn't go down. Yes, but at this stage here, when you don't see all that the candles going up there, you don't know, right? So there's a whole bunch of risk here. Emotional capital drainage, right? Your brain that plays tricks on you here. You start doubting yourself. You start blaming your best friend for recommending gold to you, right? It's like it gets nasty here. When the money goes up, everybody's happy. When it goes sideways for a year, 2 years, 3 years, 4 years, people they start turning on each other. And look where we are today. If that thing falls here below that line, we get a close here. It's going to be officially in correction mode on the monthly chart. It's already in correction mode on the weekly chart. So now look on the weekly chart. I'll just remove all my drawings. It's already on the correction mode here. See on the weekly chart, the distance from that 36-week moving average. So that's omnious in the sense that, well, you're in a correction. There's no low risk entry until at least a new breakout line morphs into existence. And then you get a breakout here. The momentum, even on the weekly, hasn't turned up yet. So it's just price is slowing down there. It's that longer term. The monthly chart is stretched. There's froth. There's FOMO. It has to be cleansed a little bit. So that's what's happening right now for the gold market there.
Mm-hmm. So Pat, in this broader context of basically the entire precious metals, let's say, complex and bull market, how do we think about, or how are you thinking about what follows from this giant move that gold has had? Like, does that capital start get attracted into the other parts? And do we have, let's say, a way to confirm that the next to move is going to be silver and then the miners somewhat after that? Or are we taking different leaders here?
Yes, well, silver, the miners have been doing pretty good. I'll show you two charts. For me, this is the gold. This is the chart that tracks silver, that silver tracks. I'll remove all drawings. I'll put on the yearly chart. So here is gold that broke out versus look, 1 touch, 2 touch. This is a yearly candle chart for gold versus inflation. So we had a breakout last year, a confirmed breakout last year for gold.
Of gold versus
of inflation. Gold versus inflation. So that was like, wow, that was huge. Now you look at this. I'll overlay the silver chart. A new price scale. I'll put on the linear, logarithmic, and I'll put candles. I'll put candles. Oh, you see it here, guys. I don't have to put candles here, and I'll just put it thicker, like here. Okay, and I'll put it on top. Visual. Okay, here's a silver chart, and look what silver tracks. It tracks not gold. Tracks gold's performance versus CPI. For me, I used to look at silver and I used to look at the gold versus SPX chart and silver overlaid on it, and it used to track pretty much. But this relationship I haven't found a better relationship for silver. So silver, it's not JP Morgan, it's not all the supply and demand, it's not solar panels, or I should say instead, it's not only any of these single narratives, it's this. From a macro standpoint, as long as gold is it's very simple. Gold price divided by inflation, that's what silver tracks. And look what's happened to silver. It's just following in gold's footsteps. And the true breakout for silver could potentially happen this year. Because look at this there. This is silver yearly chart. I'll remove this. Look at that, man. My goodness, it's happening there. This, people often say, oh, we're below the peaks of the 1980s and the peaks of 2011. Guys, those are blow off top peaks. If I look on the yearly close basis, we're golden here. We're golden because we haven't had yearly closes above 30, 31, and ever. The breakout line is here and it's happening now. We're breaking out now there. So this year, silver could get a yearly defined breakout on its own price chart. All it has to do is close somewhere here at the end of the year, 35, 36. It's done. Lock it in. It's done. The greatest breakout of all time that nobody's talking about is the yearly silver chart. It is just magnificent. And that thing should sustain silver price for a decade to come there. It's like that thing, higher lows, and now we're doing higher highs here. So we're above the 2011, 12 highs. We're above the 1980s high. Goodness, it's like, here you got a target, non-greedy target, at least, $65. And then after that, you just got these bigger patterns here. Pull flag. I know the big targets are coming out, but you get another target here, up to $128. And that's not just like, but look at it could take years, guys. Could be 2033 there by the time we get that there. Mm-hmm. But these are the targets. And these are yearly candles. You could have the GFC type of event, and you could barely see it here. Here in the silver chart, here it is, the GFC there. Goes down, but then the next year it bounces up. Gold, you can't even see the GFC in gold. Look at that. Where's the GFC here? You can't even tell there was the GFC here. It's right here, guys. Gold actually finished green that year. It's like, what a chart. Mm-hmm. So that's a big picture for me for silver. Silver is actually possibly going to break out. And silver is the best thing to play in a precious metals bull era, which is bull markets on nominal price charts, but also outperforming SPX. Silver is the top dog there. You can't go wrong with silver in the bull market there.
Mm-hmm. So then, Pat, how do miners look as well versus versus silver? Like, are the miners really starting to accelerate? Like, is there still a decent entry point? How do you see that situation? And since you're always looking at these charts, do you look at buying an ETF of miners, or do you look at buying individual miners?
The miners, 100%, I go for individuals, because the issue of the miners, the ETF, it just underperforms some of the great, like, look, I'll just show you guys this. This you should look at. Okay, here's the miners monthly chart. I put ASA, but guys, it's the same thing as JDX, but more data. It's the capital flows are the same. But if I would put, let's say, Wheaton precious metals, new price scale, log. Here's Wheaton. Look at Wheaton, way above. Here, see, it did a higher high here. It's like tracking gold, higher high here, lower high. And now, yes, the miners as a whole are finally back at their 2010 highs. But look where Wheaton is above its 2010 highs. It was here at 118. Now it's already at 189. So you should have just been you should have just been in Wheaton. You could have been in Dundee Precious Metals. Like just take one of these big ones. Mm-hmm. And so I don't want to. Yeah. There's always, because think about it this way, there's an ETF, it's a mixed bag, right? There's a whole bunch of crap in there, and there's the leaders. But when you look at charts, you could just extract the leaders from that are holding the price of the ASA up, instead of just playing the whole of them, just play the leaders, the top 5 in them. And that you could objectively see it on the price charts there. Look at that Dundee. Look at this thing there. The miners have been in a bull. This thing has been in a bull market for a long time there. My goodness.
So that being said, Pat, going back to my question, is there reasonable entry points, or has all of the precious metals complex basically taken off? Look at this Dundee stretch now. So with gold being stretched, look at Dundee, look at it stretch. Like every time it's been stretched that much, top here, important correction. The setup's there for an important correction there. So yeah, it could keep going up a little crazy, but it's your stretch. The classical TA measure moves. There's no lower entry for the leaders.
What's happening right now is the leaders have been leading for a while, so they're stretched. But the ones that are just starting to wake up, they're the smaller cap stuff or the stuff that people have. So there could be some miners that's just looking to break out. But if the leaders start faltering and starting reaching their targets and people exiting and correction mode starts, it's going to hurt even the ones that had a hard time taking off there. So that's why it's important to go in the leaders. So you ride that, because the late bloomers, they might get the rug pulls happen because the leaders they're just ending their runs there. So yeah, they're 100% no low risk entries, guys. It's easy. Pop up a chart, put the distance from moving average, 36-month moving average. If you're not down here and moving up, coiled and tight, moving up, coiled and tight, moving up, you're just not in low risk entry. And as soon as you're up here somewhere where previously you're stalling, it's done. So no low risk entries for the miners. For these ones I looked at, there could be other ones, but the ones even the ASA there, like I put ASA.
What about like GDXJ, Pat?
Okay, I'll put GDXJ.
Let's try that.
But you'll see it's the same as the ASA chart. Like I'll put GDXJ. New price scale. Where's it? Log. Yeah. It's actually worse than ASA. Yeah, okay, I'll put JDXJ. It's actually worse than ASA. So I'll put JDXJ. And I can remove this. So yeah, look at JDXJ. Look at the bottom pane. Look how stretched it is. Mm-hmm. We're in FOMO territory, man. Right? Haven't you seen on my feed, Patrick, my miners they used to be down 20, 30%, 50%. I'm up 300%. Like look at that. It's done there. We're approaching, goodness, even here, there's a whole bunch of measured moves. So, okay, I'll give you here's a move added here. Okay, so this is how it works. You have classical TA measured moves, guys. So it's what I'm doing here. Classical TA, pull, flag, measure move, target reach. It's done. So you take your targets. You don't care if the price keeps going up after you reach your target. You just bail. You're approaching. You're stretched from the moving average. You just bail. But now you could also do it with a trend analysis. So from a trend perspective is, okay, I'm above, I entered here above both moving averages doing a golden cross, and I will only sell once the price closes below, let's say, my shorter term moving average, the blue one here. So even if the targets is reached, even if the price is stretched, even if I should have exited, my classical TA would have made me exit, let's say right here, I will keep riding it until, and I'm going to put my squiggly line, I will keep riding it until the price, let's say like this, until the price closes below. Okay, let me clean this one up here. Until the price closes below my shorter term moving average, which is right here. Put a blue color for you guys, or green. I'm colorblind. So once the price, whatever the price does here, you will sell once you get a close below that. So from a trend following, and let's say it does keep going up, and let's say it does that there. Everybody's praying for that there. Like, let's say moonshot, right? Like something, as a trend follower, you might sell all the way here. So some people, sometimes what they like to do is they take half their profits when they're stretched from the moving average like this using classical TA, but then they say, I'll let half of it ride on the trend, just in case the trend keeps going up. Mm-hmm. But what I've often noticed is, while the trend might keep going up for a little while, once you got a signal to exit using classical TA, the likelihood that it keeps going up without any meaningful corrections, they diminish, and you do often get a correction. Maybe it's slightly higher, sometimes slightly lower. And it's a little bit of opportunity cost sometimes there. So, it might happen like this. The correction might happen much higher here, but you might sell here. And with the classical TA, you would have sold at this level. So yeah, a little bit higher, but also there's more time that went by, right? So there's this to put in your calculation. So, it's a mixed bag. There's pros and cons of exiting depending on the system you're using there.
Mm-hmm. So based on using, let's say, distance from moving average, we should be taking some profits for sure.
100%. Yes, 100%. On that time frame, the monthly chart, which is there's still, it's heavy. It's heavy enough to know once you're approaching it. But what you could do is you could let it go up. And then what you could do is just zoom in, let's say on the weekly chart, remove drawings, and you could wait until the weekly chart loses momentum. Wow, which it did actually. It lost momentum. So the correction has started on the weekly chart. Will it resume upwards? We'll have to find out how that resolves. But yeah, the correction here has started. The low risk entry on the weekly chart would be once the moving average is the reset all the way down here. So yeah, even on the weekly chart, there's some slowdown where you could give it a runner's chance, and you say, I'm going to wait until the monthly chart, until a rising support line here, until we get a close below that rising trend line. I will hold on, just in case.
Pat, one of the other charts, or let's say topics, that I wanted to cover with you is what the bond market is signaling right now. Does it signal turmoil? What are the twos and tens telling us?
Yes.
And especially kind of combining that with the seasonality that we typically get kind of going into September, October here. Is the bond market kind of showing us that there is some caution to be warranted as well?
Oh, goodness. 100%. Look, it's not about being a bear, guys. It's about, are the markets stretched on their own price chart? Yes. Have they been in a long-term bull run? Yes. Are they versus currency in circulation versus money supply? Are they stretched? Yes. Is gold trying to turn up versus the stock market? Yes. It's like all this stuff adds up, right? Is the unemployment super high and unwinding? That's bullish for stocks. No. Is the unemployment low and starting to turn up? Yes. Usually there's issues that happen at these areas. So here's the tens on the same price scale, percentage price scales as the twos. The black one's the tens, the twos are here. And you'll notice that when they stick together and they hover the same percentage, usually it's like the market likes it there. It's grinding hot, no problem. When they start trending downwards and the twos trend downwards, but gapping away, so the 10 minus 2 chart would actually be rocketing upwards. Bam, recession. When it reflates the twos, then you go in power mode. See here, the twos, the 90s are one of the greatest runs there, all the way to late 90s. The twos and the tens running together, hot. Top market does great. Here's a capital rotation event in the early 2000s. Look at that, the tens and the twos falling, but then after that, the twos falling more. So it's that shorter term recessionary pressures the market's pricing in. Recession. Then again, here's the reflation, this power mode for stock markets. Here again, both trending downwards, GFC, but the twos really plummeting more. So shorter term expectations for inflation really going down the toilet. Again, GFC, huge event here. Here, 2011-12, look, as it going up, power mode for the stock market, going down together, COVID, the breakdown. Look what's happening today there. Now, okay, we've had that power mode here for the stock market, fine. A little bit like the 90s. I don't know how long that's going to last. But here, look, the twos are starting to tread below the tens, right? And they're both angling downwards. It's what you start seeing here at these areas. Now, the catastrophe will be when the twos vomit. So that's probably when they cut rates. The twos are going to vomit. Or they're going to cut rates because the twos are vomiting. Often it's because the Fed fund rate is tracking the 36-week moving average of the twos. And that's probably going to happen with, again, another bearish revision of unemployment numbers. We got that little scare last week or a week ago there where they revised the numbers. Oh, it's like they could do that, revise. Well, if there's another revision and deeper revisions, that could really spook the markets once again. And considering that everything's stretched and not coiled and low and tight, you just gotta, like, it doesn't mean you bail on the market now. You could keep riding the trend, but the low risk entries, they're just not here again. Again, the low risk entries, guys, is when the twos are down here and catching up back. See here, 2002-3 bottom, the twos are lows and reflating. That's the best time. And then when it's in the power zone here, here are the twos, 2011, bottoming, going up. That was like a great bull run for the stock market. So the stock market, the bond market is telling me that the setup is there for a rug pull, for sure.
So Pat, are there any other, let's say, ratio charts or anything like that you're finding useful and important at this point as well?
Look, I think the most critical one, without adding too much like noise, gold versus SPX. It's rounding, starting to turn up. So that's like a big clue number one. No, it's not the stock market is supposed to outperform gold way more than it's doing now in a true bull era for stock market. So stock market's not in a bull era anymore. It's in a bull market. Now it's neutral versus gold. You got the tens and the twos high and starting to turn down. I could have showed you the unemployment chart. It's 4.2 now, it went back up. So it was at 4.2, 4.1, now 4.2, starting to trend up, continue to trend upwards. And goodness, do you see the Canada unemployment? We have as much unemployment as we had back in the GFC lows. It's crazy. It's like, how come officially there's not a recession declared? I have no idea how they're not declaring it. But it's like the unemployment rate is as high. The number of unemployed people is as high as it is back in the abyss of the GFC today. How does that make sense? Crazy. And and the Canada, US economy were like this. It's like I could overlay the UK macro, the tens and the twos and all that. It's all linked. So the setup's there, Tom. I don't want to be a doom guy, but the setup's there. But of course, you could only action on it once the charts actually tell you that, okay, here it is, guys. Here's a low risk entry. Here's the confirmation for the capital rotation event, and that's how we play it.
Mm-hmm. Well, Pat, I mean, with many of these things, it always helps to have the backing of the evidence of the charts and always, getting this longer term perspective, I think, is extremely helpful, and understanding those, even just the distance from moving average, right?
It's objective, it's mathematical, it's unbiased, and it really helps. Like sometimes you hear news about something. Oh, my friend made this 4-bagger on this miner. Okay, well, just pop up the chart, guys. Just look, is it stretched from the moving average? Yes. Well, maybe you missed a bunch of the run because for your friend to brag, that means a lot of energy went into there, and he's going to probably, some of the guys who bought early, they're going to want to take profits, right? So you're buying when these guys have made money. If they made money, they're probably going to take profits. It's not optimal.
Mm-hmm. Excellent. Well, Pat, always appreciate the conversation and the thorough look through the charts. Of course, all of your stuff, much of what we went through was all available on your X feed at Bad Charts One, and you guys go through more in-depth stuff as well at northstarbadcharts.com, right?
That's right, Tom.
Perfect. Pat, thanks so much for your time today.
Thank you, sir.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.